I mean, you've identified a couple of opportunities here: Bassware, TrustBuddy, Glyph, Pitterpig, Global. But that's sort of it, really, at the moment. Are you expecting a lot more to come onto the market in the next 12 to 18 months? If I had to put you on the spot, over the next 2 years, how many IPOs do you think we're going to see?
I mean, 3 or 4 months ago, I would have said quite a few. I mean, I've heard rumors today that Zopa is about to IPO.
Well, I'm sure we'll ask Giles. He's in the front row. So.
Several times, of course. I mean, none of these guys are ever going to admit it. I've also been asking Ron if Prosper has it on the cards, but a lot of these guys have very jaundiced views actually of the public markets. I think they've had bad experiences where they've seen companies just get on the back foot. Market doesn't understand them, loses patience, and basically public market listed share price is more trouble than it's worth.
Right. So how many in the next 2 years?
What, excluding on deck, and I would say I think we should see about 10. But
10.
We'll see about 3 or 4.
Okay, very interesting. Okay, cool. Simon, I'm going to kick off with actually Simon and Geoff as two of the listed entities here, both of you with significant experience of equity markets in many shapes and guises. Simon, could you raised 200 million on your, it's an investment trust, isn't it?
That's right,
Yeah.
It's an investment trust.
So it's a closed-end fund investment trust under the UK language.
Yep.
And you're looking, what, average yield 6 to 8%? Would that be about right once you're invested?
Our prospectus said we were looking to return a dividend to our shareholders of 6 to 8, but we obviously have an element of retained earnings as well.
Okay, fine. And you're, Cormac said you're about 3 to 6 months away from being fully invested, about right?
I think at IPO we said it will take 9. We're around halfway done after sort of 4 and a bit, so we're well on track to be, and deployment's accelerated thanks to sort of our relationship with platforms like Rata, to Zopa and Funding Circle.
And are you likely to hit that estimated yield, or are you likely to? I mean, the premium on the share price might imply that you might be doing rather better.
Yeah, I think. Well, I mean, given where yields are elsewhere, if you can get, frankly, anywhere near that number, then you reflect well compared to the rest of the investment trust world, the rest of equities. You'd be lucky to earn a 4% yield on any UK equity, or something that's around the average.
Equity.
You're lucky to earn anywhere near that on the UK bond market. So I would hope even at the bottom end of our targeted prospectus yield range, we're at circa 50% above the average coupon on a listed equity.
And I suppose a leading question: you raised 200 million. Could you have raised more?
Could we have raised more?
Yeah,
we could. I certainly think we could have raised more, but we would have given ourselves a bigger headache. So the more you raise is great, but you have to deploy it.
Okay, I was going to ask you about that deployment. It's not exactly to my question, which is, has it been easy to deploy?
Not easy. We're fortunate we work with some great platforms, and I think that symbiotic, we've got better, and we're definitely getting better all the time at nurturing that symbiotic relationship with the platforms, and I'm looking at Giles and Ridian in particular in that, and that's been very helpful. So our rate of deployment today is probably 6 times what it was when we first started back in June. So our weekly rate of deployment has increased 6-fold by effectively perfecting our relationships with the platforms and helping each other to make it work a little bit better.
So that's a big message, really, for any of the institutional investors in here. You are going to have to spend a lot of man and woman hours effectively building those relationships, as well as the credit algorithms that go with it.
Yeah, actually, when I spoke earlier this morning, one of the things I said, I think we as a business need to learn to do a lot better is, and I gave the analogy, if anybody was there, of the car industry. The car industry learnt in the 70s beating up your suppliers is not a good idea. They used to sort of bid down their suppliers to the lowest possible price and kill them. Now they've learned having long-term relationships with suppliers with 10-year contracts and where they share R&D, share logistics is much better. And I think if the platforms can have, and the capital can have those kind of symbiotic relationships, we'll all be better off.
Geoff, we're going to look a little bit later on in another panel at your VC kind of more venture capital investment, so I'll leave off them for the time being. I think it's fair to say that you have a variety of stakes in a variety of businesses. You're putting money on platform as well, though, aren't you? That's the important thing. You're not only just investing in the platforms, you're putting money on the platform. And again, are you getting the kind of returns that Simon's been talking a bit about? I mean, you're more SME focused, small business.
Yeah, basically very similar.
Yeah. So am I getting a premium for investing in riskier small businesses by investing in? Because would I be fair to say that with Simon, you're probably weighted a little bit more towards consumer, I imagine, and then business. You're more small business related, aren't you? Are we seeing a premium? Am I getting closer to 10%?
You will be getting close to double-digit net yields.
Net yields.
SMEs, yeah.
Yeah. And where have you found the sweet spot for putting money actually to work on platform?
It's really a case of doing the stuff that the banks really can't or won't do. Because if you're going to be similar to the banks, then you're going to be at a much lower net yield, because fundamentally it just becomes a question of the technology firepower that you have to be able to put to work to actually analyse the loans. If you're doing things which are far more difficult to do, so it requires human underwriting, it requires understanding the nature of the risk over and above simply a quant analysis, then you're going to get paid a higher yield. Some of it is to do with relationship banking. It's doing all the stuff that the banks have no interest in doing anymore, but you do get paid more for it.
And is there enough capacity? I mean, how much money have you put on platform to date?
We've currently got about 40 million sterling of loans.
Okay. And have you found that relatively straightforward to deploy, or have you had to work quite hard?
I think at the moment the origination has been relatively modest in the early part of this year. It's accelerating rapidly, and certainly we'd expect a very significant amount of origination in the first quarter and second quarter of next year, as we've got a number of additional platforms that are currently doing very little that are actually going to start be doing some very serious numbers. Mainly
UK, or are you starting to put money to work on platform US now as well?
We will probably end up with something in the order of 50% US, 20% UK, 20% Europe, 10% rest of the world.
Okay. Oh. Okay, that's very interesting. So we'll come back to that international mix a bit later. Okay, Peter, now you rerun an American fund. You're surrounded by a lot of Brits, I apologise. And an Irish, yeah, sorry. I'm glad you're not Scottish, because I would have said something as well. So, Peter, you're an American fund, so you're at the coalface of America. Talk us through how much money you've been raising, because you're a hedge fund traditionally, but you've been raising money and you've been putting money to work. So how much money have you put to work so far? What kind of yields are you getting back?
Sure. So we're a San Francisco-based relative value asset manager, so our background is primarily corporate loans credit.
Yeah.
We started investing a couple months ago, been looking at the space for about a year. And we're investing primarily in small business loans and consumer loans. We've signed a deal with about 4 platforms so far. And similar to what you're saying, on the SME side, it's around a 10-11% net yield. And consumer loans are more in the high single digits.
And how are you, as a question I probably should ask Simon as well, how are you analysing risk? Are you effectively taking the risk models that are being given to you by the platforms and just saying, okay, that's fine? Or are you sort of saying, no, we want to do our own algorithms, we'll do our own analysis? Are you finding a discrepancy between what the platforms are telling you and what you're finding?
That's a good question. I mean, I know a lot of people out there talk about loan level selection and cherry picking the platforms and how they're going to earn 500 bits of alpha versus taking a generic index. I think we're a bit skeptical of that overall, and if you want to buy 1% of Lending Club or Prosper's index, maybe you can outpick. Our sense is that if you buy more than that, that alpha will go away, and it'll certainly go over time. So we're more interested in figuring out what slice we want to own. So whether we want to own A, B, or C's, there are some credit overlay metrics we apply internally that we think provide a little bit more safety. So I would describe it more as, do you want to own high yield debt or IG debt? And are you somebody who looks at cash flow coverage ratios versus asset ratios? So we sort of apply some of that corporate methodology to what we're doing on this side of things.
If I can almost, so what you're saying is the alpha that you can get would be, say 100 basis points. So effectively what you're almost saying is, again, I hear the same thing. If we're a hedge fund, we could use clever alpha, we can get it up to 200-300%. Almost what you're saying, asset allocation, i.e. picking the buckets and working out how to allocate between SMEs, consumers, as important as analysing those risk numbers.
I mean, it almost feels like if you're somebody who's comfortable investing in the ABS market, the great thing about the marketplace lenders is it's 1 degree deeper, where you're actually getting to pick loans that fit your profile. And in any given month, we can turn up and down the spigot of, do we want to own more of the risky loans? You know, everybody today wants to use Lending Club. E and F rated loans because they have high 20s yield and there's no default. So you can earn 25% risk-free, supposedly. But our sense is there's always going to be a washout, and we're more concerned with coverage ratio metrics and how much room do we have for things to go wrong. So if we can pick that today we want to own this platform and the A's and B's, and tomorrow we want to own property lending, E's and F's, then I think that's more important. The other part is really the ability to hedge, and can we use the rest of our infrastructure to use different assets that might have negative correlations with what's going on in consumer credit or small business credit.
Okay, just bring you in here quickly, Cormac. I mean, what's your sense in terms of if you're a professional money manager, hedge fund or an asset manager coming in space, what's the realistic alpha, to emphasise Peter's point? Can you get more than 100 basis points?
I think you can, actually. I mean, I think there are multiple ways to generate alpha. One is, as people said, to allocate cleverly into the right kind of buckets, if you like. But then I think within buckets, we're in touch with some people that actually have proprietary approaches, and they claim to be using artificial intelligence, and they've generated very impressive track records doing that. So actually, we think there are multiple ways to generate alpha, and I mean, I come from an industry that makes money from finding inefficiencies. In the market. I think inefficiencies in marketplace lending will persist for 5 or 10 years, and I do think if you work hard, you can generate probably 2-3%. Or maybe a better way to put it is like multiple of the net yield. So if the net yield is 10, I think you can come out at 12 to 13% net yields if you're clever, actually.
Andrew, if I can bring you in here, do you think that when you talk to hedge fund institutional investors, I mean, you're predominantly institutionally based anyway, and mainly offshore as well, yeah. So when do you react with a bit of surprise when some institutional investors come in and say, I'm just going to work those numbers and I'm going to get a much higher return than the market? Or do you give them a wry smile?
I am smiling when I heard Cormac say that, because I dealt in hedge funds for over 10 years. I've seen probably more back-tested simulations than you'd want to look at. And unfortunately, the truth and the fact afterwards is they never meet the expectations. So I'm not a firm believer in that. I think what you have to approach it by is, particularly we have family offices backing us, and we'd like to broach into hedge funds, is simply that they would look at our own credit assessment. We always focus on the security packages involved and how we're going to get repaid. We're not lending to a business per se, although most of our loans are SME lending. We're lending to the entrepreneurs who are wealthy and have sufficient net wealth that we're not going to worry about our security package, although we take and perfect proper security. So the hedge fund side is, we are definitely talking to more and more hedge funds, more and more what we call co-lenders rather than peer lenders, because we're dealing at a high net worth. Our average loan is 2.5 million sterling. And at the moment, although we've done 45 million, and we use our own capital, very similar to Graham at Wellesley, this year, we don't have enough size for them yet. The hedge funds would want to deploy normally, we from my experience, 10 to 20 million tickets sizes, and then multiples. So we need to build out our loan book and then be able to actually gravitate towards them as serious co-investors or co-lenders in the future.
And so, to paraphrase, in a sense, what you're suggesting is that hedge funds and institutional investors are better off looking at more specialist niche asset classes and people you lend to as where you'll get, and mixing those up within a portfolio. That's where you're going to get your superior returns from.
Absolutely, and the risk-adjusted returns, which everyone's, the alpha everyone is searching for, is very elusive.
Yeah.
So all you can try to do is apply a commonality of approach that is iterative and also can be progressive moving forward and evolve. One thing I've learned already in 15 months in this industry is the speed of evolution is remarkable, and it's Darwinian by nature that there will be natural winners through the natural selection of the process.
Graham, I just want to finish with you. Now, Wellesley & Co. have, been growing very fast in the last year in the UK. Do you want to? What's a realistic expectation of an institutional investor came to you at the moment? What are they going to get, and what are you lending on?
Well, I think Cormac referred to two things in his earlier speech: is one, skin in the game.
Yeah.
And what we do is change the perceived or real risk in returns on our loans by taking proprietary risk against those defaults. Equally, we try to create a very scalable model.
Yeah.
And so when you look at our website, you don't see individual loan opportunities. We actually reallocate on a weekly basis pro rata funds to every single loan we have to try to perfect diversity. But from the actual, a little bit like politicians forgetting to work, who they're working for, the actual voters, our lenders, we are a scalable model. We don't want to go to the smaller niche sector of the lenders who want to look at a menu of loans and individually choose them. We put up our own capital and our track record to give that confidence.
So how do you put your own capital up? Just to quickly explain how that works.
Well, right now we have a default fund similar to other players in the market. We fund every loan with our own capital, and today retain an ongoing 5% proprietary interest in every loan with our own money, excluding the default fund. And if there was a default, we would take the first loss.
So you've got default and your own skin in the game?
Equally, not contractually, but today we have £8 million proprietary funds against an outstanding loan book of 85 million. And because we pay a fixed interest, not a per opportunity interest rate, I can't see right now where a default existed in either capital or interest where we would not cover that loss, simply that the brand value, net yields and experience of our lenders, a loss of confidence would cost us so much money in terms of the yield we had to provide that we would always cover that, although we are not contractually obliged. Equally, in terms of attracting institutional capital, the things that people don't see in the world is we work for our individual lenders. That's the real market. Every institutional asset manager is managing someone's money. And when we've looked at wholesale relationships, of which we have them and we hope to expand on them, one thing we will never do is give the top slice, the top mispricing of risk and yield. We'll adjust their risk, but we use our proprietary capital to do that. We'd never want a situation with our tens of thousands of lenders where they took the bottom piece of the pie and the institutions, because of speed, technology.
So pari passu, you're going to try and have them at the same level.
So one thing we would always, we have and will always hope to retain is that all our lenders, whether institutional or retail, will have exactly the same exposure. And I think that's fundamentally and morally very important.
And just to finish up, because we're going through a couple of quick panels here, just quickly going through realistic expectations of return, blended return across your platform?
We're actually returning over 10%, and we expect that to be maintained.
Okay. Graham?
Will be between 5.5% and 5.8% net, with paying for funds committed, whether lent or not.
Peter, investing in your fund, realistic rates of return?
I think on a levered basis, low teens.
Okay. Okay, well, thank you very much, gentlemen. We've got a quick series of panels, so I'm going to ask you to give a round of applause to our gentlemen here, and we're going to move on to our next panel. Thank you very much.